As I said earlier, demand for goods and some services is now far outstripping supply, resulting in elevated inflation. With the labor market already very strong, it's important to restore the balance between supply and demand and bring inflation down. A number of factors should help accomplish this rebalancing, and monetary policy has an important role to play. First, with the Omicron wave now ebbing, and COVID vaccines and treatments much more widely available across the globe, we should see a gradual restoration of supply and a resolution of associated bottlenecks and shortages. Over time, consumers should also start to cut back on buying goods that are in short supply and switch back to in-person activities like travel, dining, and entertainment, where supply is less constrained overall. Together, these developments should contribute to more balance between supply and demand in the economy. The second factor is fiscal policy, which provided a huge boost to the economy during the past 2 years, but is unlikely to be as significant a source of demand this year. And this is true not only for the United States, but also for many other economies. It's a point I just should reinforce all the time that COVID has been a global phenomenon, and a lot of these issues are not just unique to the United States, but truly global in nature. Last, but definitely not least, is monetary policy. After providing maximum support to the economy for the first year and a half of the pandemic, the FOMC is adjusting the stance of monetary policy with the aim of bringing demand in balance with supply, and thereby bringing down inflationary pressures. The same is true for many other central banks around the world, which either already have moved in this direction or are expected to this year. Now, the initial step in that process was the FOMC's decision to first reduce and then end its net purchases of Treasury and mortgage-backed securities. So these purchases, they pushed down longer-term interest rates, making it less costly for consumers and businesses to borrow, and contributed to favorable overall financial conditions that supported spending. Now, the next step will be to raise the FOMC's target range for the federal funds rate, and that's the short-term interest rate at which banks lend to each other. In March of 2020, the FOMC reduced the target range for the federal funds rate by 1.5 percentage points to near zero. And this very low interest rate contributed to the sharp rebound in demand, which propelled the strong labor market recovery that we saw last year. But with today's strong economy and inflation that's well above our 2% longer run goal, it is time to start the process of steadily moving the target range back to more normal levels. In particular, I expect it will be appropriate to raise the target range for the federal funds rate at our upcoming meeting in March. Now, once the interest rate increases are underway, the next step will be to start the process of steadily and predictably reducing our holdings of Treasury and mortgage-backed securities, which had grown significantly as a result of the purchases that began back in March of 2020. Now, last month, the FOMC released a set of principles that will guide that process. And assuming the economy develops roughly as I expect, I foresee this process getting started later this year.